As a more extreme example, Turkey's broad money supply and consumer price index both more than doubled over the past year and half, with upward of 80% year-over-year inflation at the peak, while their interest rate ranged from 8% to 18%. Consumer level interest rates are higher than that, but still, it's a massive amount of inflation relative to interest rates. There's a strong market incentive for people and companies to borrow Turkish lira and use it to buy US dollars, gold, stock, real estate, Bitcoin, art, wine, or basically anything that is expected to have a better 3 to 5 year return than the lira, which is almost anything. And by borrowing lira, they create more lira. So I borrow lira, I need to return you certain amount of liras. The interest rate is between 8% and 18%, but because the inflation is 80%, then the lira that I will need to return you is much less than the interest rate. They simply refuse to hold much of it, which contributes to a collapse in the lira's purchasing power, and thus higher inflation for imports, including energy. So historically, raising interest rates above the inflation rate is a key method to try to slow down bank lending and thus slow down the broad money creation that is caused by excessive bank lending, and it creates stronger incentives for entities to hold the currency, which strengthens it and can lower import costs. This is the type of environment where higher interest rates get a reputation as an inflation-fighting tool, with Volcker in the 1970s being the most well-known example. So what she's saying, the bottom line of what she's saying is that raising the interest rate is not always the solution to inflation. It really depends whether the inflation was caused by increased spending, increased debt, or that it is caused by increased money supply. And the claim is that in our case, because it's not an increased money supply, because it's not an increased just increase of money supply, but an increased depth, then the interest rate is not the only tool. And we look at the 70s with Volcker increasing the interest rate as the solution, but it's not the solution. Although practically when we looked at the actual inflation, at least the numbers that are reported, we do see that increasing the interest rate did affect it. This works reasonably well in an environment of low public debt. Exactly what we said. So this works well when there is low public debt, but only money printing. And when high rates of bank lending are primarily the cause of money supply growth, like the 70s. If interest rates are notably above the inflation rate, it does encourage many types of borrowing and encourages holding the money instead. It also pushes down asset prices, which makes them less powerful as collateral for loans. Conversely, if the economy is growing sluggishly and central bankers want to boost growth with more bank lending, then cutting interest rates is a tool that is reasonably effective. However, the effect is not linear, and we saw that in developed markets during the 2010s decade, if mortgage rates go down from 15 to 5%, as they did in the 80s and 90s, and average house prices are reasonably multiple of average worker incomes, that can indeed encourage a lot of new borrowing and credit creation and boost price inflation and boost home building and the need for home builders. Okay, so what she's saying is that when the mortgage went from 15% to 5%, then this caused a boost in borrowing, boost in the economy, boost in money supply, because whenever you take a mortgage, you pay someone. So this someone spends it. However, if mortgage rates drop from 5% to 3%, interesting. So she is discussing the difference in mortgage rates between 15% to 5% and from 5% to 3%. But from 5% to 3% and average house prices are already unusually high relative to the average income. That doesn't necessarily encourages much more borrowing. And on the other side of the equation, if the interest rates are super low for a long period of time, like we had in the recent decade, then banks are not being well compensated for the risks of lending and may be rather strict by only offering loans to very credit-worthy borrowers, which also results in rather low levels of borrowing. So during the 2010s, disinflationary, so not inflationary. We didn't have a deflation, but we didn't have inflation, disinflationary decade, many central banks try to go lower and lower in terms of interest rates, including below zero. Below zero seems strange, but they would actually pay you to borrow, to try and encourage more bank lending, which didn't really materialize. Interest rates and fiscal deficits. If inflation is caused by a runway of fiscal deficits, high interest rates do not really do much to stop this. So let's repeat this again. If the inflation is caused by a runway of deficits and not printing of money, then high interest rates do not really do much to stop that, because high interest rates would make people borrow less. But we are talking not about borrowing less. We're talking about the global country deficits. A central bank and the commercial banking system in general is basically forced to finance its government's runway fiscal deficits anyway. So if they are printing money to help the government put more money into circulation than it removes, then changes in interest rate are going to be distant second in terms of any impact they may have. So what we're saying here is that if we print money, if we put more money in the circulation, then this is the first cause of inflation. And the second distant one would be the interest rate. It's like giving someone Tylenol when they have a gunshot wound. Yeah, okay, so this is like a small medication, or maybe some bands when they have a gunshot wound. What really needs to be done is to stop the bleeding, yeah. At first, raising interest rates in the face of high deficit-driven inflation can slow inflation down, which makes it seem like it's working. Actually, this is what's happening now. It seems like it's working. This is because the Fed can potentially reduce the rate of bank lending and thus slow the economy down a bit, even as those fiscal deficits keep pouring in. In other words, they are not affecting the primary cause of the inflation, but they are subduing enough other things that they are able to push back against the primary cause indirectly. Over time, however, raising interest rates and keeping them high in an environment where runaway government deficits and higher government debts are causing inflation runs the risk of exacerbating inflation. High interest rates on large amount of government debt. So if you already have debt, and this is the situation that we are in, the government has a lot of debt. Larger, we saw that we reached almost 250%. 100% of GDP will result in even bigger runway deficit, because now we need to pay higher interest. Because now they are dealing with ballooning interest payments on the debt. So the government also needs to pay the interest rate. So if you raise the interest rate and we have a large amount of deficit for the government, they need to pay more. And this ironically pushes more money into the economy. How do they pay? They print money, more money into the economy. A deficit for the government is a surplus for the private sector, unlike a household or corporation that can default on its debt during complete inability to pay. A sovereign government that is in debt in its own currency can just keep forcing its central bank and commercial banking system to print the difference instead of nominally defaulting and thus pushing more and more money into the financial system. For this reason, if the Fed had raised rates sharply from the 1940s war, it likely wouldn't have reduced inflation and could easily have exacerbated it. So what she's saying is that there are times that when you raise the interest rate, you will just increase the inflation, as weird as it may sound, because if you raise the inflation, you need, if the cause of the inflation is the government debt, then the government will need to print more money in order to pay the higher interest rate. And because they will print more money to pay for the higher interest rate, more money would be in the system, and you would just increase the inflation because you raised the interest rate. This is because the Fed and the commercial banking system were stuck monetizing the fiscal deficits anyway. The interest rates would likely not have changed how much war spending was done. And the deficits would have been bigger due to more interest being paid on the debt, which would have created even more money and pushed it out into the economy. Why this is complicated? Analysts often debate with each other about the relationship between the interest rates and the inflation. The conclusions are often too simplistic because they often only look at either the bank lending channel or the fiscal deficit channel of money creation, rather than both simultaneously. And to make it worse, it's often politicized. Hard money or easy money economics approaches are very politically sensitive economics topic. And so people tend to talk past each other rather than with each other. A number of analysts keep calling for the Fed to get more and more hawkish to cool inflation. Their view has been if 3% raised rates didn't do it, then go for 4%. If 4% didn't do it, then go for 5% interest rates. If 5% doesn't do it, then go to 6% and cause a recession if need be. If a firm enough grip has been placed on money in their view, then surely it will iron the inflation out of the system. In fact, Taylor Rule says the Fed should have gotten up to nearly 12% interest rates, and now back down to only 8% in this cycle. This type of model is based pretty much entirely on the premise that lending-driven money supply growth, which we said is not the current cause of inflation, at least as she said, is the primary cause of inflation. So we are looking here from the 60s, the Fed funds effective rate, so the effective interest rate, and the inflation. We do see that when we increase the interest rate, then the inflation is going down. Or the gross domestic product is going down, not the inflation, implicit price deflation. Let's see what she says about it. And indeed, higher interest rates may work in the short term for indirect reasons. If money gets tight enough over a cyclical period, then it could indeed cause a recession. Okay. So here they compare the federal funds effective rate with the GDP. So what we're saying is that when we increase the interest rate, then the GDP goes down, we are cooling down the economy, and so we expect the inflation to go down. And indeed, higher interest rates may work in the short term for indirect reasons. If money gets tight enough over a cyclical period, then it could indeed cause recession and temporary drop in inflation. The private sector gets squeezed with higher interest expenses and tighter credit standards, and asset prices drop or stagnate. This is a theme I've been tracking since 2022. However, what many of the hawks are missing is that raising rates increases the fiscal deficit. Yeah, because we need to pay more money to pay for the deficit of the country. And the deficit has been the primary driver of inflation in this cycle, rather than excessive lending. It's more like the 40s. So she's saying that in the 40s, the primary cause of inflation was the deficit of the country and not the lending. So increasing the interest rate won't fully solve it. We are used to looking at the short past, at the 70s, where the cause of inflation was the money lending. So there, the interest rate would solve it. So she is saying, no, you need to look at the 1940s, not at the 1970s. So does that mean the solution is to hold the rates low? Idov Vishnes the answer. Not necessarily. No. That's the strategy that Turkey had been trying to do, and it hasn't worked well. When inflation began to worsen in 2022, they cut the interest rate under 50%, and inflation exploded to over 80%. So Turkey, here the interest rate, in 2022, they cut the interest rate and inflation exploded. So Turkey inflation rate is usually something like close to, what is this, 10%, down bigger than, and then it exploded here. Money supply and the consumer price index have been like a rocket, also in Turkey. This is the money supply. So the money supply in Turkey is also, exploding. The problem with Turkey's situation is that cutting interest rates may indeed reduce the portion of inflation caused by the fiscal. Okay, so maybe there are two portions of inflation. One is caused by fiscal deficits and another caused by lending, but it exacerbates speculative attacks on the currency. Yeah, and inflation caused by bank lending, and makes it so that nobody wants to hold lira, including especially foreign entities, who wouldn't borrow Turkish lira at a low rates and buy almost anything else with that lira. The lack of monetary tightening encourages rational actors to do so, and who would hold lira at such negative real rates? On the other hand, if inflation is mainly caused by government deficit spending, and the central bank relies too heavily on raising interest rates to cool it, mistakenly thinking that would work to cool lending-driven inflation, can also cool a fiscal-driven inflation, then that can be a policy mistake that feeds inflation instead of tempering it. Okay, so I have to say that the article is detailed. It's also complex. Can be overwhelming if we are new to the topic. But the point is simple. On the 1940s, and the claim is that also today, the inflation is caused by depth of the government, and raising the interest rates won't necessarily fix it. Maybe part of it. While everyone are under the assumptions that raising interest rates would solve the inflation because they are used to the 70s. Argentina currently has an inflation rate of over 100%, and unlike Turkey, they've been aggressively raising interest rates to keep up with it, and yet inflation remains completely uncontained and actually even worse than in Turkey. So in Argentina, they are raising the interest rates. Okay, so the dashed line is the interest rates. Basically here they raised it. Okay, when it's going down, when the inflation goes down, they lower the interest rate. When the inflation goes up, they make the interest rate high. But we don't really see that. It's not killing the inflation. Nothing happened here to the inflation. Maybe the curve is a little bit with less deviation, but still they couldn't kill the inflation with super high interest rates. Argentina's money supply and consumer price index have been like a rocket ship as well. So this is the money supply in Argentina increasing. Looks very similar to Turkey's. It's almost as if interest rate policy isn't the only variable to consider here. For the United States, as previously described, there have been periods where one form of inflation dominates over the other. In the 1940s, it was the fiscal-driven inflation that dominated the United States. In the 70s, it was the lending-driven inflation that dominated the United States. In the 2020s, it's fiscal-driven inflation dominating again. A tool that works in one environment may backfire in the other environment. In some rare contexts, for developed markets and more commonly in developing markets, both can occur together, and that's particularly toxic mix to manage, as described below. The hardest inflation combination. Aggregate price inflations can be cured by having low money supply growth relative to the growth in the supply of goods and services. Of course, that's much easier said than done for certain economic situations, but that simple lens at the end of the day helps us assess what measures. So asking here the question is, okay, so at the end of the day, what should we do to cure inflation within the context of the financial system as it's currently structured? And whether certain measures that are being taken are likely to be successful or unsuccessful on a structural basis to fix inflation. If inflation is caused by war or by demographics bulge and the high rate of bank lending, it's perfectly fixable. War-driven inflation can stop, at least in rate of change terms, with prices permanently higher at a new steady state. Once the war ends and the government returns to a rather austere financial baseline, lending-driven inflation can stop, and just in rate of change terms, with prices permanently higher, either due to the demographic bulge ending naturally or by tightening monetary policy and slowing down credit creation by bankers. In the 1910s and 1940s, the US had high deficit-driven inflation, but had a clear way to bring down after the war due to the lack of locked-in entitlement spending and low ratio of dependence to workers. Sharply raising rates against this backdrop would have likely not helped inflation, so again, a case where it would not have inflation and instead could have made it worse. The focus should have been and was on fiscal normalization. In the 1970s, the US had low sovereign debt to GDP around 30%, and thus had a clear path toward monetary tightening to rein in the rate of bank lending and consumer demand without blowing up the fiscal budget. Higher rates encouraged foreign entities to hold more dollars, which helped strengthen the dollar and lower import costs, and also crush the economic of certain foreign developing countries that had a lot of dollar-dominated debt, which reduced their consumption of oil and other commodities and thereby left more for the United States. A dovish policy, if not raising rates, could have spiraled into uncontrollable lending-driven inflation and in avoidance of the rest of the world to hold dollars. And so raising rates to positive inflation-adjusted level made sense. The hardest inflation combination for a central bank to deal with is one: a high sovereign debt to GDP. So the inflation caused by debt is harder. Large and structural fiscal deficits tied to aged demographics, they need to pay more, and imbalanced entitlements programs, and high military spending with no clear resolution in sight. And then 3, significant supply of constraint, such as tight oil markets or labor shortages. Due to high public debt levels, this combination is a very different environment than the 70s, and a closer environment to the 40s. Again, the claim that we are not in a situation like the 70s, but in a situation like the 40s. Although, at least in the 40s, had a more temporary spending reason. So federal debt, the debt of the federal, the country held by the public. So this is starting from 1903, it's raising, then decreasing, and now raising. Okay. 2053. Interesting. If they bring out the 1970s playbook against that combination of high debts and deficits as they have been, and greatly increase interest rates over a multi-year period, then they can reduce money creation from bank lending in the intermediate term, but ironically exacerbate inflation due to further widening of these fiscal deficits and deficit-induced money supply growth on the longer term. And so far, that's what's playing out. Asset prices stagnated in 2022, which led to weak capital gain taxes in 2023, and so tax revenue suffered. Meanwhile, higher interest expense increased government spending, and thus the deficit began re-widening as interest rates went up in the late 2022 and throughout 2023. So the deficit are growing as spending and revenue diverged. Spending as percent of GDP and revenue as percent of GDP. However, if they bring out the 1940s playbook and keep interest rates low, despite the high inflation, it reduces the fiscal-driven inflation a bit, but encourages speculative attacks on the currency by borrowing it and using it to buy harder assets with it, and thus making more currency in the process. Or it merely convinces people to sell dollars and buy hard assets, thus weakening the currency considerably and causing more import price inflation and energy price inflation. That way, when a country has a twin deficit, fiscal deficit and trade deficit simultaneously, it is vulnerable to some big swings in its currency value if it's not monetary tight enough. In other words, on one side is a rock and on the other side is a hard place. As a Star Trek analogy, it's a Kobayashi Maru, meaning no-win scenario. The Kobayashi Maru is a training exercise in the Star Trek franchise designed to test the characters of Starfleet Academy cadets in a no-win scenario. The Kobayashi Maru test was first depicted in the 1982 film Star Trek II, The Wrath of the Khan, and it has since been referred to and depicted in numerous other Star Trek media. So we have a Star Trek fan here. The notional goal of the notional goal of the exercise is to rescue the civilian spaceship Kobayashi Maru, which is damaged and stranded in dangerous territory. The cadet being evaluated must decide whether to attempt to rescue the Kobayashi Maru and engendering their ship and crew, or leave the Kobayashi Maru to certain destruction. If the cadet chooses to attempt a rescue, an insurmountable enemy force attacks their vessel. By reprogramming the test itself, James T. Kirk became the only cadet to defeat Kobayashi Maru. The phrase Kobayashi Maru has entered popular lexicon as a reference to a no-win scenario. The term is also sometimes used to involve Kirk's decision to change the condition of the test. Other analysts have used the Kobayashi Maru analogy to describe policymakers choosing between inflation and recession, and indeed that is a similar situation and one I have been analyzing, but at high enough depth and deficit levels. It can instead become a choice between fiscal-driven inflation and lending-driven inflation, and it becomes a matter of timelines. For this reason, those types of environments often result in capital controls and various restrictions on lending eventually, which is the government's version to reprogramming the test. Specifically, in that context, lawmakers generally want to reduce interest rates to quell the fiscal-driven inflation while also avoiding the speculative attacks on the currency that such negative inflation-adjusted interest rates would encourage. They want to reduce various ways to borrow money to buy private assets, while mandating institutions to buy government debt at interest rates that are below the prevailing inflation rate and closing the various exit doors that people turn to in order to avoid the holding the developing currency. This can take many different forms. Throughout the 40s, the United States and other countries had strict capital controls. Owning gold was punishable by up 10 years in prison for Americans, and it was purposely hard to transfer money globally. The United Kingdom also had restrictions on the ownership of various financial securities during wartime. Similarly, Turkey, over the past year, has been restricting lending to firms that have a lot of foreign currency to offset the natural incentive that occurs when interest rates are so far below the inflation rate. They don't want entities to be able to borrow lira and buy financial assets with it. Indeed, making it hard for businesses and individuals to access dollars or other foreign currencies is a common tactic used by developing countries, governments experiencing high inflation in order to try to protect their own currencies. Some countries, such as Argentina and Nigeria, have cut off access points to cryptocurrency exchanges well to try to slow down the outflows from the currency there. But the problem with capital controls, beside from ethical issues, is that they result in a top-down command and control economy, and capital keeps wanting to escape if possible. IMF working paper from 2015 called the liquidation government debt described this in detail. Here was the abstract. High public debt often produces the drama of default and restructuring, but debt is also reduced through financial repression, a tax on bondholders and savers via negative or below market real interest rates. After World War II, capital controls and the regulatory restrictions created a capital audience for government debt, limiting tax-based erosion. Financial repression is most successful in liquidating debt when accompanied by inflation. For the advanced economies, real interest rates were negative half of the time during 45 to 80. Average annual interest rates, expense saving for 12 countries sample ranges from about 1 to 5% of GDP for the full 45-80 period. We suggest that, once again, financial repression may be part of the toolkit deployed to cope with the most recent surge in public debt advanced economies. The Fed's new BTFP facility is a mild form of this. It provides liquidity to banks so that they don't need to sell treasuries or mortgage-backed securities. However, that liquidity is expensively priced, which discourages them to use it beyond their needs. Bank funding costs are going higher and their incentive to lend is weak. As a result, private sector credit is tightening disinflationary while public sector money creation continues to be facilitated with any liquidity that may need inflationary. In such environment, politics are likely to get quite heated. In a period of prolonged high interest rates, high inflation, and high government interest expense, some politicians will argue and have argued in past analogues that government shouldn't pay such high rates to its lenders, that government is being unfairly squeezed by its lenders, and so forth. They can also argue that the high interest rates are exacerbating deficit-driven inflation, so the level of interest rates can become a very hot political topic, with some politicians advocating for lower interest rates and capital controls and increases in taxes, and others arguing for higher interest rates and major cuts to government spending, but of course not on the parts of the government they like, just on the parts that their opponents like, which doesn't get sufficient votes. As the fiscal deficit remains large and unresolved between these different viewpoints, the situation risks spiraling into a vicious cycle. The combination of structurally high public debts, high fiscal deficits, and tight resources supplies is why I expect the later portion of the 2020s decade to be volatile and generally bouncing and back and forth. between inflation and stagnation, and without good inflation adjusted returns for the major of US stock. When people say they want low inflation, what they really mean is that they want disinflationary growth. They want inflation fixed by more supply, not due to suppressed demand. If we get inflation under control by having a recession and then stimulate our way out of that recession and have yet another round of above target inflation because of it, then that's not really fixing the problem. That would just be bouncing between inflation and stagnation without much disinflationary growth, which is the actual target. Okay, so this article is good, but it's also complex. It's hard to follow and to understand. It's really good. It's very detailed. It's super important. She's making really good cases. It just goes so deep that it's a little bit hard to follow, but I guess that's the truth. The devil is in the details, or the angel is in the details. Okay, so we have to go to this tip. I don't see another way around. To address the underlying cause of inflation would be outside of the Fed's purview. Also, she has good viewpoint. Since it's more of a fiscal countdown, the government would likely have to restructure the public debt and the existing mix of taxation and spending, encourage more industrial and energy it's genius production to come online, and then leave it with the Fed hardened to currency under this point. That combination might give a decent foundation for a period of longer-term disinflationary growth, but it's extremely difficult to do and is basically non-starter. Politically, yeah, it's complex, hard to understand, but very detailed and genius. Summary points. Okay, this sounds promising. Summary points. High interest rates help to slow down bank lending. High interest rates help to slow down bank lending, yeah. And to incentivize various entities to hold the currency. Thus, high interest rates help reduce money supply growth from borrowing and help reduce speculative attacks on the currency. This mainly works in an environment of lower public debt and deficits, and where higher rates of bank lending are the main contributor to money supply growth. However, high interest rates also exacerbate deficit-driven inflation, specifically during areas with unusually large sovereign debt and deficits, above 100% debt to GDP and above 7% structural deficit to the GDP. Each increase in the interest rates puts some disinflationary pressure on the private sector, but also results in even larger public sector deficit pouring money into the economy. If those public sector deficits are big enough, then high interest rates can actually be inflationary. Many developed countries, including the United States, currently have a high debt to GDP ratio unlike the 70s and large deficits, and thus actually need low interest rates to not exacerbate a fiscal-driven money creation over a multi-year period. However, low interest rates in an inflationary resource-constrained situation could encourage excess bank lending, including to buy harder assets, which would also lead to an acceleration of money creation or could lead to a spike in imports and energy prices. So this combination generally leads to government attempts to restrain bank lending on things that are not considered good for national interests, while also trying to keep interest rates, expenses, and liquidity for the government at workable levels and the resulting politicization of the interest rates. As of this writing, the interest rate decrease over the past year haven't fully affected things yet. For either the private sector or the public sector, it comes with a long variable lag. For the private sector, many homeowners and corporations have longer-term fixed debt, and only some portion of it matures each quarter and gets refinanced at higher rates. As more private debt matures and gets refinanced at higher rates, this will continue to serve as a disinflationary and recessionary force on the economy, especially on sectors more sensitive to interest rates. For the public sector, about half of the federal debt is long-term and will continue to mature and be refinanced at higher interest rates. The country has debt, but they need to pay the interest they need to pay the debt holders. How they do it? With refinance. Just like you refinance, take another loan, the government takes another loan. But when they come to take the other loan, if the interest rate is getting higher, then they get higher rates. This will continue to serve as an inflationary and stimulatory force on the economy at a 32 trillion debt, sustained at 4 to 6 interest rates, eventually result to 1.3, 1.9 trillion in annual, oh my god, almost 2 trillion in annual interest expense as more debt matures and get refinanced toward that level. All of that adds to the deficit and pours into the economy. Federal government current expenditures interest payments. So the interest payments is going, I think you would agree with me that the interest payments is going higher. Therefore, somewhat stagflationary conditions persist with two powerful forces pushing against each other. Right now, the cyclical disinflationary side is slowly winning with a tightening 2022-23 after 2020-21 period of rapid fiscal money creation. But I don't think we've seen the end of the high inflation this decade. Specifically, the next time we have a period of economic acceleration, it's likely come with a side order of inflation again. Yeah, so this was the article by Lynn Alden, who, as you see, goes very deep and has a unique view on the current inflation crisis. She claims that we are closer to the 1940s and not closer to the 1970s, that interest rate can solve only one part of inflation, not the whole part. It could actually cause more inflation. I encourage you to go to her website called Lynn Alden Investment Strategy, read this and the other amazing blog posts, or just read the summary. And with that, we finish this article.